Nigeria is one of the largest economies in Africa, with over 240 million people and massive natural resources. So why do so many investors avoid it? At first glance, Nigeria looks like a high-growth opportunity, but once you look closer, the picture becomes much more complicated. Nigeria is not a small frontier market. It's one of the largest economies in Africa, alongside South Africa and Egypt. Nigeria is, however, one of the most populous countries in the world with approximately 240 million people. That alone makes it important, but it's also a regional hub for trade, finance, and energy. This isn't a niche economy. This is a major frontier market with global relevance. Nigeria's economy is built on oil, but unlike other economies built solely on oil, it's also more diversified. You have oil exports, agriculture, telecommunications, and a growing fintech sector. Nigeria's trade is bolstered by its membership in the Economic Community of West Africa States, giving it preferential trading with West African countries. It is also a member of the World Trade Organization and the African Continental Free Trade Area. This gives Nigeria access to trade with over 100 countries around the world. Nigeria is both resource-driven and population-driven, and that creates a very different type of growth profile. Nigeria has a functioning stock exchange, the Nigerian Exchange Group, with major banks, consumer companies, and industrial firms. But liquidity and accessibility are inconsistent. Therefore, even if companies perform well, getting your money in and out can be the real challenge. Let's talk about the Nigerian currency. Nigeria uses the naira, and this is where things get difficult. Over the last 15 years, the naira has gone through roughly half a dozen major naira devaluations or exchange rate resets. FX restrictions historically. Over the last 10 years, there have been repeated FX restrictions. In 2015, a restriction was placed on access to official FX for 41 import categories such as rice, cement, poultry, and other goods. This policy was later broadened in practice and became a symbol of Nigeria's FX regime. During the 2016 stress period, restrictions were placed on commercial banks' FX trading and closure of official auction channels. In 2021, dollar sales to exchange bureaus were stopped as a way of tightening access. Then in October 2023, the central bank lifted the FX ban on 43 items, which shows that the system has been shifting away from some of those restrictions, while some do still exist. Gap between official and parallel rates in Nigeria, currency risk isn't a side issue. It's the main event. Nigeria presents economic growth opportunities. Nigeria's opportunities come from population growth. Over the last 15 years, the population has grown from approximately 158 million people to 240 million. Urbanization and an expanding middle class. Few markets in the world have Nigeria's combination of scale and growth potential. What are the risks of investing in the Nigerian stock market? Currency instability, inflation. Over the last 10 years, inflation has always remained above 10%, reaching a high of 34.8% in December 2024. While Nigeria has grown in population, per capita living standards have improved unevenly, and recent inflation and currency weaknesses have severely hurt household purchasing power. Policy inconsistency. Since taking office in 2023, President Bola Tinubu launched three major economic reforms. 1. Fuel subsidy removal. This cost the Nigerian economy $10 billion per year. Because of this, fuel prices spiked and the cost of transportation and food costs surged, causing nationwide strikes and protests and a cost of living crisis. 2. He removed FX controls and unified exchange rates, allowing the naira to float. This devalued the currency by 30 to 70%, depending on which measure you use. This caused import costs to surge. For foreign investors, This caused local stocks to become cheaper in dollar terms, drawing in the interest of foreign investors. Third, he tightened monetary policy, reducing central bank money printing in an effort to stabilize inflation in the currency. Right now, Tinubu is pushing industrial policy improvements, export diversification, reforms on the oil sector, and growth in the private sector. And the last risk is capital controls. How can you access the Nigerian stock market? Right now, there is limited direct access. The only options are ADR or GDR. There are some mutual funds or ETFs that have emerging or frontier market exposure. The known ETF trading in the U.S. that invests in Nigeria is the VanEck Africa Index ETF, ticker AFK. If you're looking for exposure to Nigeria through a managed fund, there are funds available primarily through local brokers in Nigeria. Speaking of which, if you want to go directly to the source, you'll have to contact a local broker. This, of course, does present its own challenges, such as opening an account in Nigeria, transferring funds internationally, and those institutions' own procedures for trading shares. A word of caution. A weaker currency makes assets look cheap, but only countries with credible policies turn cheap into opportunity. Nigeria is one of the most important frontier markets in the world, but importance doesn't always translate to investability. The opportunity is clear, but the challenge is navigating the system around it. If you're interested in deeper analysis on frontier and emerging markets, markets most investors overlook, consider subscribing. This is Frontier Market Intelligence.